What if I told you there's a publicly traded company whose entire business strategy is just to buy Bitcoin? No, they are not a crypto strategy, and no, they don't mine Bitcoin. They just keep buying it non-stop. This company, MicroStrategy, or now just Strategy, owns over 500,000 Bitcoins. Some call it genius, others say it's reckless. But here's the thing, they are not just buying Bitcoin, they have built a financial flywheel that kind of print money out of thin air and buy more Bitcoin. In this video, I'll break it down exactly how they do it, why some people think it's a Ponzi scheme, and whether it's even sustainable if Bitcoin crashes. So stick with me because this strategy could reshape what it means to be a tech company in the crypto world. So let's start with a bit of backstory. MicroStrategy used to be just another software company, but in August 2020, they made a huge move. They spent $250 million to buy 21,000 of BTC. That shocked Wall Street because this wasn't a crypto company. It was a public listed tech company suddenly betting big on Bitcoin. And the explanation is that the fiat money was being eroded by inflation and Bitcoin appears to be a more solid long-term store of value. So their approach is definitely very forward-looking compared to Wall Street. And fast forward to June 2025, they now hold over 550,000 BTC, more than 2.7% of all Bitcoin in existence at an average cost of about 70,000 per coin. This made them the biggest corporate holder of Bitcoin on the planet. But the question is, where did they come up with that amount of money to buy so much Bitcoin? Well, here's where things get interesting. Strategy built something they call the Bitcoin flywheel. The engine that powers it is something called convertible bonds. Simply put, this is a type of debt. Investors lend Strategy money and instead of charging interest, they get the option to convert that debt into Strategy shares down the line, usually if the price share goes up. And in Strategy's case, these bonds often come with a 0% interest rate. Yes, that's right. Investors are lending them money for free. So why would anyone do that? Because they believe MSTR stock will go up as Strategy continues to buy more Bitcoin. Let me give you a quick example. Let's say I lend Strategy $100 today when the stock is worth $100 per share. If by 2028, MSTR stock is trading at $200, I can convert my $100 debt into $200 worth of stock and walk away with a profit. So when you understand this concept, this is where the flywheel starts. They will first raise money by issuing these convertible bonds, then they use that cash to buy more Bitcoin. As Bitcoin price increases, so does the value of the stocks. Then they will use that premium to raise even more money, and that's basically how MicroStrategy can print money out of thin air. What? They can do that? Yes, and it's kind of like building skyscrapers. As the value of your buildings rises, you borrow more against them to build new ones, and Strategy is doing the same thing, but with Bitcoin. Now, you might be thinking, isn't this bad for shareholders? Aren't they being diluted every time new stock is issued? Well, here's what Strategy argues. If you issue stock at a high premium and buy Bitcoin with that proceeds, you actually increase the Bitcoin per share. Michael Saylor, who's the executive chairman, calls this the Bitcoin yield. Here's a direct quote of Michael Saylor. We sold $1.5 billion in stock, backed by $500 million in Bitcoin. Then we bought back $1.5 billion in BTC. We essentially gained nearly $1 billion from that arbitrage. And so far, this strategy has made investors really happy. You can actually measure this happiness using something called the premium to NAV or net asset value. NAV is the total value of the Bitcoin they hold. If MSTR stock trades about this NAV, that premium means investors are betting on the strategy, not just the Bitcoin. And that premium lets Strategy raise even more capital, continuing the flywheel. So why are investors willing to pay extra for shares, even though the value of Bitcoin inside the company doesn't change? Because MSTR is like a leverage bet on BTC wrapped in a traditional stock, and that leverage can outperform the underlying asset. Just take a look at this chart. MSTR stock outperformed Bitcoin and even Nvidia over the past year. That's why investors are still buying in. But now, let's address the elephant in the room. Michael Saylor's Bitcoin yield plan basically works really well in a bull market, but what if Bitcoin crashes? Would MicroStrategy be forced to sell all of their Bitcoin to pay off debt? Would there be a margin call? Well, surprisingly no, not immediately anyway. Well, here's the good news for MicroStrategy. Based on the latest available numbers, the price of Bitcoin would need to drop by 80% before the assets, mostly Bitcoin, are worth less than the total debt. That's a massive crash, and most analysts say it's pretty unlikely to happen anytime soon. Even though the company doesn't hold a ton of cash for short-term payments like interest or dividends, the chance they go bankrupt or have to sell their BTC right away is still low. Why? Well, that's because most of the debt is in convertible notes. These are type of loan that doesn't require Bitcoin as collateral, and they can often be refinanced, meaning extended or restructured without needing to sell anything. They also issue something called perpetual preferred stock. This is a type of equity which, believe it or not, never has to be paid back because it's not a loan. So they're not under any pressure to repay that anytime soon either. Now, let's clear up something important. Just because the price of BTC drops doesn't mean MicroStrategy has to sell it all. Even if they're temporarily in the red, meaning the price of Bitcoin is lower than what they paid, that doesn't automatically trigger a forced liquidation. This is because, well, once again, the debt isn't backed by Bitcoin as collateral, so if Bitcoin falls, they don't face margin calls like us people trading with leverage do. In other words, no one can force them to sell just because price dip. The only way they'll be forced to sell Bitcoins is if the company faces a fundamental change like going bankrupt or being taken over. But Michael Saylor, the company's founder, still controls over 43% of voting power, so he can block pretty much any major decision. That makes a forced sale very unlikely. And even in worst case scenario, let's say Bitcoin drops to 30,000 in 2027, they'll still be sitting on around 15 billion worth of BTC. So to cover the debt, they only need to sell about 7% of it. But why does this work? Because the return on Bitcoin, historically about 50% a year, has been way higher than the interest they pay on debt, which is between 0% and 8%. That difference is what makes that whole flywheel strategy work. Borrow cheap, buy Bitcoin, let it grow in value, and repeat. Still, some critics say, isn't this just another Ponzi scheme? I mean, they keep raising money, using it to buy Bitcoin, and getting more investors to come in. Well, at first glance, it does seem that way, but here's the key difference. A Ponzi scheme requires new investors to pay off old investors. Strategy isn't promising any fixed return. It's just speculating that Bitcoin will go up. So it's risky, of course, but it's not illegal and it's not a Ponzi scheme. But of course, there are still major challenges for the company itself. First, don't forget there are now Bitcoin ETFs. These are simpler, more direct ways to invest in Bitcoin, and they have pulled investor interest away from MSTR stock. After spot Bitcoin ETFs were approved in early 2024, Strategy stock began trading closer to NAV. That premium shrank and it became harder for them to raise new capital. Second is the tax law changes. Starting in 2026, companies like Strategy may face new tax on unrealized gains. Under the US Inflation Reduction Act, companies earning over $1 billion per year could be hit with a 15% minimum corporate tax. Thanks to a new accounting rule, Strategy must now report Bitcoin at fair value, including unrealized gains and loss. That means these paper profits might turn into real tax obligations, and that could become a big cash drain, so MicroStrategy might need more cash on hand, even though we know the company is not a big fan of holding fiat in their balance sheet. But now, since we are near the end of the video, I kind of want to throw back the question to you guys and understand your perspective on this. So do you think Michael Saylor is the biggest genius in corporate finance or a madman on borrowed time? But I'll add to this. Strategy's model has already inspired imitators. According to Financial Times, 78 companies now hold Bitcoin on the balance sheet. One of the most successful cases is a company called Metaplanet. It is a struggling Japanese hotel chain, but since they adopted Michael Saylor's strategy, their stock shot up after they made that first BTC purchase. So here's the chart and you can see exactly when the rally started. So do give a thought about it, let me know what you think by dropping a comment below. In the meanwhile, if you're curious about the humanoid robot scene between the US and China, check out this video right here.